Hello and welcome to the Global View on this Tuesday. I'm Andrew Kagan. Good to have you with us here at ausbiz. Let's take a look at what happened overnight. Equity markets edging higher as investors focused on the prospect of further rate cuts in the US and Europe. Stocks on Wall Street made modest gains amid comments from Fed policymakers and steady factory activity data. 8 of the 11 S&P 500 sectors were higher, with energy stocks leading the gains and healthcare stocks declining. Among the mega caps, Tesla shares surged while Meta rose after Citigroup lifted its price target on the stock. Intel shares increased on media reports that Apollo Global Management has offered to make an investment of as much as $5 billion in the chipmaker. General Motors slipped after Bernstein analysts downgraded the carmaker stock to market perform from outperform. And the shares of gold miners rose as the bullion price hit another all-time high. Newmont and Barrick rising along with US listed shares of the South African miners. And US listed shares of BHP and Rio were up around 1.5%. Well, US Federal Reserve policymakers have said the half-a-point rate cut last week was justified because it will sustain what they see as an emerging and healthy balance in the economy. Chicago Fed President Austin Goolsbee said if conditions continue as they are now, there are lots of cuts to come over the next 12 months, saying I'm comfortable with starting a move like this. If we want a soft landing, we can't be behind the curve. And Atlanta Fed President Raphael Bostic saying inflation had fallen faster than he expected, saying in this moment, I envision normalising monetary policy sooner than I thought would be appropriate even a few months ago. Well, the US rate futures market has priced in a 50-50 chance of either a quarter or half percentage point rate cut at the November meeting. Meanwhile, data has shown US business activity was steady in September, but average prices charged for goods and services did rise at the fastest pace in 6 months. And the S&P Global Flash Composite PMI, which tracks the manufacturing and services sectors, was little changed at 54.4 this month from last, with a reading above 50 indicating expansion in the private sector. US Treasury yields have drifted higher, with the 10-year at 3.74, the 2-year at 3.58, and the euro has dropped against the US dollar as business activity reports from the Eurozone economy disappointed, with Germany's decline deepening, while France returned to contraction following August's boost from the Olympic Games. And the Aussie dollar sitting at 68.3 US cents. Okay, let's get across what's moving markets for analysis. Steve Sosnick is joining us from Interactive Brokers. Steve, terrific to catch up with you again. Of course, this time last week we were speculating what the Fed was going to do, and well, look, perhaps a bit of a surprise because I think that the most assumed they were going to go 25. They did opt for the larger cut. Now, of course, we've had, as I mentioned there, a long line of Fed commentators coming out. What have you made of what they've had to say, given they've essentially justified that 50 rate point cut?
Well, good morning, Andrew. It is kind of fascinating. Again, this week, last time, the market was sort of moving toward 50 basis points. And it's interesting because unfortunately, the morning after I spoke to you, so it's nighttime here, the next morning, I had a conversation with a longtime market watcher. And he was adamant that the Wall Street Journal wouldn't have printed the story about that 50 was on the table during a quiet period, unless they'd gotten it from someone in the Fed who wanted to get that message out, because neither the Wall Street Journal reporter nor the Fed wants their credibility questioned. So, so I sort of begrudgingly said, all right, well, if the market's saying 50, I got to respect 50. That said, I'm not. I guess the Fed really moved. Something must have come out at that meeting because I still sort of sit here scratching my head and going, what changed? Because I do think that the 25s make sense. I think Powell went out of his way at the press conference to say, don't expect 50 basis point cuts at the coming meetings. Of course, the market does because they're still pricing in three 25 basis point cuts over the next 2 meetings. So at least one of them, by definition, would have to be 50. The economy is doing okay. Interest rates are coming down. The part of the problem I have here is we don't really know what their target is. They keep saying that we're restrictive, it's not obvious that the monetary policy is restricting anything when you have the S&P at all-time highs and interest rates at relative lows and no credit spreads very tight and no one particularly looking for having any trouble borrowing money. So what is their goal in terms of neutral? And that's really the question that I'd like to get out of them. What do they intend to do here? Because it shouldn't be about markets, and it isn't about markets. But then what is it about the economy? Is it just that they see price pressures coming down and they want to be more accommodative, or is there something else going on that they may not be telling us?
Well, what do you think neutral does look like? Or is it too hard to say at this point?
Personally, I think 3.5 to 4. I put out a chart today. You could find it on IBKR Campus or IBKR Traders Insight. I put out a whole bunch of charts, but basically, I think people are fretting about the fact that real interest rates are somewhat positive. Well, that's been the case throughout history. It really hasn't. The abnormal period is really the 2010s and on, when we got very used to the idea of relatively zero nominal rates and essentially negative real interest rates, both of which are really historical anomalies. And so the question is, where do they want us to go? I would think, if you have some sort of real interest rate, which seems to be to me, the way to go, you're talking probably in the 3.5-ish range, maybe 4. The chart you have up there, it shows you the effective QT, quantitative tightening. And you can see it had an effect in the beginning when they started tightening. But basically, at this point, it doesn't seem to be doing anything because the stock market just keeps ripping higher, even as the Fed balance sheet shrinks. The only notable little bumps there are, you could see that little bump on the top graph. That was when the Silicon Valley banking crisis happened, and the market took that as an all go ahead. The Fed's putting money on their balance sheet. So there's many different ways. I would like to hear, so I would love to hear what the Fed has to say. Where is their end game? And they've been relatively quiet about that.
So, what's the prospect of a soft landing then, Steve? And I'll point you to your next chart, in fact, the 2 and the 10, that inversion that we've seen. But you're making the point that that precedes a recession, but then that only begins after that curve normalizes.
Yeah, this is what this unfortunately is one of the more ominous charts I've put together recently. This one, you know, I, I'm on team soft landing. I really do think that. I really do. I'm not rooting for anything negative to happen to the global economy. Problems in China potentially being exported notwithstanding. But what this chart shows is it's the difference between the 2-year yield and the 10-year yield. Well, 10-year minus 2-year. In most cases, that's positive. You see, there's roughly 4 instances in the last since 1985 that it hasn't been. And actually, you really can't see the one right before COVID because it was like a blink of an eye, so it doesn't really show on the charts. There were, I guess, 5 of them. But each of the inversions preceded a recession. But you could see there the red line being the date that the National Bureau of Economic Research, the NBER, the sort of the group of economists who decide that things are recessions, you'll see that they only start after the curve normalizes, and we're sort of at that point now. Again, I really do hope we escape this, and the Atlanta Fed is basically predicting 2.9% in their Fed Now forecast for GDP, which would be pretty good actually. So here's the problem: if it's really 2.9%, and we really do have only an unemployment rate of only 4.2% or so, that's a pretty good economy. So yeah, I guess it is good if the Fed is cutting rates into it, but how far do they have to go, and why, and where's their destination? On the other hand, if they feel the need to cut rates because they see pressures building that they're not really talking about, that's not a great reason for rate cuts. So, I'm really hopeful of the soft landing, but wary that, that something could be lurking out there, and you never really know what that is. And I just have to question what the Fed sees, what the granularity is there.
Yeah, and that's a consideration for investors. I mean, what do they need to consider, given, I guess, they're trying to work out whether these sizable rate cuts that well, just happened, but also to come, whether that actually means good news or bad news. Then, of course, also, Steve, we're heading into earnings season next month, and then the election. So there's a lot to play there.
Yeah, we get a little bit of a break here. There's not that much on the calendar between now and, let's say, middle of October when earnings season starts again. We averted a government shutdown. That's one of the little unique, insane features of the American political system, where you have to sort of vote on these budgets periodically, and they pushed it off till December after the election. Interestingly, the election, as consequential as it is, I get this question very frequently. What are markets doing about the election? And interestingly, not much, because the election is such a crapshoot right now. It's really such a coin flip, not only for the presidential race, which is a coin flip, but also the composition of Congress, the House and the Senate, that as a result, no one can actually really make any bets based on this. So in a strange way, it's actually not creating volatility, because the volatility tends to occur when something unexpected happens. In this case, nobody knows what to expect. So there's really not a lot of bets being placed on it. So as a result, markets might actually be yawning in the short term, because they're almost paralyzed when it comes to investing, at least in terms of taking sides about the election. There's plenty of other things going on that we could talk about in terms of, the momentum and things of that nature. But in terms of the earnings season, we're really going to have to, this will be another tell. If the economy is weak enough to require sustained 50 basis point cuts, it's really hard to imagine that companies will be able to reflect the guidance that is being priced into for earnings for these companies. The S&P 500, we're looking at double-digit earnings for the coming 4 quarters, double-digit earnings growth. Can you get that if you have an economy that's weak enough to require 50 basis point cuts? Or are the companies seeing something that maybe the Fed isn't telling us, or maybe they haven't told us yet? That's going to be the real key to earnings season. But what it means in the short term is, market's going to muddle along doing whatever it does without a lot of catalysts.
Interactive Brokers Chief Market Strategist, Steve, thanks for joining us.
My pleasure, Andrew. We'll talk soon. Take care.
Let's turn our attention to the local market as we get set for an opening. As you can see, is expected to be modestly negative, with SPI futures down around 0.1%. Stay with us, because the open is just a couple of minutes away.